Good afternoon, everyone. This is Christian with PerfectStockAlert.com, a 100% free service for smart investors and traders. All we ask in return, please refer a friend. Today is February the 20th, 2012, and like I do every weekend, I run my scan for value alerts. And I could do an alert on JP Morgan or something like that, but instead I'm going to do something different today. I'm going to show you something a little bit different that we've not done before. Let me get out the tools here. We're looking at Cimarron Investment Corporation, might be pronounced Cimarron, I'm not sure. Ticker symbol CIM. So right here, you can see that the stock on this 10-year chart actually wasn't trading for 10 years. It actually came out there on the peak in 2008. About 12.33 was its high, fell down to about a low of 101 and bounced back up here to about book value. This line right here is indicating the reported book value of $3.27 per share, and now it's closed at $3 per share, so slightly below book value. Now, we've mentioned before, just because a stock trades below book value doesn't mean it's an actual good buy opportunity. Sometimes price is predicting something completely different. Maybe this was the bad pricing in the actual company, but maybe this is, so we'll have to actually go look at the company's fundamentals to find out what we think. Okay, again, before we get into this is just my opinion. I've not read the annual report. I don't know what the company's up to. I'm just going to look at some key statistics and show you what I think about this company. Okay, I'm going to be looking at the Yahoo Finance page for this company, and you can see here's the company right here, ticker symbol right here, closing price here, after hours $2.99, and this is something that I want to bring to your attention because a lot of people run scans for various items that they then go and they do more thorough research. But in this particular case, you'll see that you've got a 14.7% dividend yield. That's something that a lot of people are going to get enticed by and want to look more into. At that high, you have to wonder, red flag. It's basically, is this dividend really safe? And we'll look at that in a minute. Earnings per share is 55 cents. Something to note about that, Benjamin Graham recommended, Warren Buffett's teacher recommended, you look for companies that have earnings per share of at least $1 or more. This is actually would be another red flag for me. PE ratio is 5.47, and as you guys know, I'll look at anything at 15 or lower, so 5 is definitely something I would look at. However, a lot of people will put too much weight in PE ratios, and they may jump prematurely. You need to look further into the company to find out, are those earnings something that's decreasing or increasing, or what's going on? So we'll need to look at that as well. Market cap is a $3 billion, so we can look at a mid cap here. So to get into this, I'm going to actually go over here to the key statistics here on this page and look further into the fundamentals. Again, I'm looking at Yahoo Finance for this. You can find this information almost anywhere. Google Finance, MSN Money, your own discount broker will have it available to you for free, and so forth and so on. You can find it all over the place. Let me clean this up and go over to the key statistics page. Alright, so here we are on the key statistics page, and we can see a couple different things right off the bat. Again, same information we've already noted. We can see the market cap $3 billion, enterprise value is $9 billion, and you can see the trailing PE ratio is 5.47. But what I want to draw your attention to is the forward PE ratio. The forward PE ratio is higher. It's 6.67%. What does that tell you? It tells you that the earnings are expected to be less going forward, at least for the foreseeable future, the next 12 months out, compared to the current. So that's something to definitely take note of. On price to book, it is actually below book. If it was at a 1.00, it would be at book. So below 1, it was obviously again below book value. Let's see what else we can find here. Scroll on down. That's interesting. Okay, you can see right now. Got the tools again. You can see the profit margin right here, and it's at 90.42%. You don't get that kind of a profit margin or profitability level unless you're up to something. Now, it doesn't have to be negative, but in this case right here, it looks like they're definitely using a lot of debt to basically run this company. Has a lot of leverage, and that can be, produce a real high profit margin, but it can also create a real problem if you get into trouble. So let's look a little bit more. Return on equity is 17.75%. I'm going to like that, and I like anything that's 15% or higher. So 17%, not too bad. And again, just because you have a really high profit margin, it's not necessarily a negative either. So these things might entice people and interest them as well. Quarterly revenue growth year over year is down 37%, and that's a hit, and that could be a lot of reason why investors are fleeing the company's stock right now. Quarterly earnings growth year over year down 43%. But again, some people who may be buying this company may be thinking, well, the earnings in the future will be improving. Well, we've already shown you the forward earnings, at least the forward PE ratio is going to be telling you another story. It's telling you that in fact they're expecting a lower earnings per share. So no, I wouldn't be betting on that either. Let's see what else we can find here. Scroll on down. Got the tools again. You can see here that total cash $9.82 million, and there's our total debt. There it is, $6.2 billion. That's the debt that I was talking about. That was really juicing their profit margin. They don't have a lot of cash invested in the company. They've got a lot of debt. And that can be a problem. If things go wrong, as things are now for this company, then you can start getting into some problems. And so we want to look at the current ratio and say, okay, does the company have enough cash on hand to deal with the immediate bills that are going to come due in the next 12 months? And you would know that they do if you had a current ratio of 1.00. In this case, you have current ratio right here, but it is a 0.07. No, they don't have a lot of cash on hand. In fact, they are burning through cash. So that's telling you whenever you have a situation like this, you know that you're losing money. Book value per share is recorded at $327. That was at the last or most recent quarter. That's when it was reported. And this is going to obviously change every moment, every second of every day. So they're only telling you what it was. It doesn't necessarily mean it is that now. Let's have a look at that awesome dividend now. And have a move over there. Check that out. Let's see what we got here. Let's raise that up a little bit more. All right. We can see that the forward annual dividend yield is at 14.7%, but you also notice the payout ratio right here, 116%. That means all of their earnings plus 16% more is going to have to go to pay for this big fat dividend yield. So what does that mean? Well, it basically means the company would have to cannibalize itself to continue to pay this dividend, or it's going to have to increase its earnings, and obviously we know that's not going to happen in the short term for the next 12 months, because we've seen that the forward PE ratio is predicting that's not going to happen. It's going to get worse before it gets better. Now, of course, that's just a projection. It could, change dramatically. We don't know. But from what we do know, we are not really all that confident that the payout of this dividend will continue. In fact, one of the methods that the company could use would be to decrease that dividend, and that's probably what would happen here. Of course, I can't tell you for sure, but from a value investor's perspective, I look at all of these signs as being something I don't actually want to be a buyer of. I think, in fact, that the company is more of a value trap than a value investment opportunity. With what you now know, having looked at all those key statistics on the fundamentals, we can look at this company and say that, in fact, at 12, it was probably overpriced. This was the mispricing up here. Falling down here was looking for actual value. And then you'll notice as you run back up here, what did you start to find? Well, you start to find some sell pressure here, here, and here. Oh, that sell pressure is higher than any buy pressure they've had. So they're actually selling at this level, finding that that book value of 327 is not likely to be true, or at least not at the moment, because the company's obviously cannibalizing itself. So 327, it's being eaten away, corroded, and therefore price falling below book value makes perfect sense to me. It really would. And on top of that, I mean, I haven't looked at the actual, the balance sheet and so forth and so on, but book value is oftentimes overstated anyway. So to be a buyer at 3 with a book value, a reported book value at 327, and the fundamentals we've just looked at, not going to happen. If you've not been to our free website at perfectstockalert.com, it's right there. It's 100% free, and all we ask in return, please refer a friend or share our videos online. God bless, take care, and I'll see you in the next video. Please take a moment to review our disclaimer. The information provided herein is our opinion only. Under no circumstances do any statements here represent a recommendation to buy or sell securities or make any kind of an investment. You are responsible for your own due diligence. To summarize, we do not provide investment advice, nor do we make any claims or promises that any information here will lead to a profit, loss, or any other result. These videos are for educational purposes only.